just there today.
Sorry, I just recorded this thing. Okay.
Great.
All right.
Great. I do need permission to share my screen from you,
Okay.
though.
So,
It's
okay.
like,
Let
yeah, I
me
can share in a second.
have.
Let's,
Okay. I just make you as a co-host.
okay. Again, this is super basic. I threw together pretty quick. So let me get the slideshow popped up. But like Bob mentioned, my name's Jake. Mike, who's on the call as well, we co-lead a investment focused team here in Chicago called the Axon Group. Our sponsored brokerage is EXP. So we are national, and we do touch a few other markets as well, including Indianapolis and select areas of Florida. But Chicago is our main focus. This is where we kind of both operate and both are currently investors ourselves. Again, this is a quick level highlight, but we service Chicago and the suburbs up to pretty much 50 miles is our main focus. 24 agents on the team with about 300 transactions in the last 2 years. And our niche is investment in small multifamily. We stick to either portfolio or small multifamily, typically under the 3 million mark. It doesn't mean we won't go higher, but we find that it's usually where our buy box is for a lot of the buyers that we rep, and also the sellers that we are presenting, deals to the market for. These are just some very quick snapshots of Chicago: average home price, average monthly rentals, population growth. There is job growth. I'll go into some other quick things here, but this is a good quick snapshot of, the third largest metro still in the country. We do still have a lot of value here in Chicago, right? So we are below the national average for average home price, but that kind of relates to the fact that we are very affordable in a sense. Same thing with our average monthly rent. A lot of value here to be an A-class international city. Good equity growth. Population growth is under the national average, but unlike what people may think, Chicago is not shrinking. It's growing. And there is very solid job growth. So it's a good rental market. Again, these are some very high level stuff that I just went over, but Chicago rents are relatively affordable compared to most A-class cities in the country. Appreciation at a steady rate. Rents have been rising. You saw that number previously. And Chicago's population in the city is up in the last 5 to 10 years. And we do see a lot of strong job growth. It's a very balanced market. Not only do we have tech, manufacturing, and a lot of professional jobs in general, but we find that Chicago is very well balanced, right? So a tech exit here doesn't really affect us. Same thing with the manufacturing. One usually makes up for the other. So that's why we see a lot of very steady appreciation and very steady growth, not a lot of jumps or dips in general. I pointed this map out. It was from an old presentation, but the property we're looking at today is actually right in this 20% gain area. So you'll notice that Chicago's a big city. Just because some areas might be experiencing population loss, a lot of the A-class areas and the areas that are close to the loop are experiencing gains. So I'd like to point out literally almost right where this arrow is pointing is where our subject property is we're talking about today. So that's good news. So I'm going to jump out of that presentation. I'm going to open up the presentation for the property specifically, if that's okay with you guys.
That'd be great. Yeah, Jack, let's go over this deal that we found, and I may have questions. So I will be more like moderators that ask questions on behalf of as an investor. And then we will definitely letting the audience to ask questions if they have any. And then I will, at the end, I will go over this particular deal, what unique about Cohome, that if we what unique about Cohome product that for this kind of investment opportunities that what we can add value for this kind of for investors to acquire the property.
Perfect. Yep. So this is the property. It is a 6-unit property, got rehabbed in the last 12 months. All the tenants in there now are the first tenants, fully occupied. So that's a quick picture, and we have more, but want to go over some of the property information and the highlights. Turnkey investment here, brick building. Chicago stock is typically brick, so an old building but very solid. We kind of say they're all built like tanks here. It is in a neighborhood called Westtown Noble Square, which is just outside the loop on the northwest side, only about like a 10-minute walk to the West Loop, which is one of the most bustling and high growth retail strips and centers in pretty much any market, especially Chicago. Just had a giant boom. That's where McDonald's headquarters is. Google has a building there as well. So like I mentioned, this property went under complete gut rehab, interior and exterior, new roof in 2022 to 2023, and has just been fully leased out through a professional management company. Most tenants are young professionals or students in the area, a lot of people that desire being close to the city center or public transportation. There are 4 2-bed, 1-bath simplexes, meaning just, single floor units. And there are 2 larger 3-bed, 2-bath duplexes that take up 2 levels. The first floor has a front and a rear duplex, and all the levels each have 2 units. So it's a 3-unit or 4-level building with simplexes in the top 2 floors and duplexes on the bottom. Pretty high-end finishes, close to condo quality, right? This is built to be a rental, but it's built to be an A-class rental, right? So modern amenities, central AC, in-unit washer dryer, a rooftop common deck with really great views. I can share a drone footage that we took of the building as well at a later date if people are interested. Ideal tenants that want easy access to transportation in downtown. It's only a 10-minute walk from the West Loop Business District I mentioned. Quick numbers, which we'll dive into. The cap rate with current rents and expenses in place is a 6.6 approximately, 14 total bedrooms and 8 total bathrooms. So that 6.6 in place cap rate comes from the NOI that is kind of driven by the gross income. If it's about $15,500 a month gross when you add in any bill backs and parking and rent. The location is technically called Westtown or Noble Square. And it's a subjective A class, but what we would consider in Chicago is a top tier neighborhood. Very attractive amenities for modern tenants, super low maintenance because of the recent gut rehab. All mechanicals are new. There is a current property manager in place that is only charging 4% gross rent, which nationally is a very competitive fee that is transferable as well. So existing management can flow into new ownership. This owner was smart enough as well to put in a RUBS fee billing platform for their tenants. So the rents, as you'll see in the rent roll, are marketed by a base rent plus a RUBS bill back for common utilities. So the overall utility expense to the owner net is very low. The building, has a bill back system in place that can be inherited as well. We said a rental history, just upside to support, $3,200 for the vacant duplex. One of the duplexes was vacant at the time of this offering. It was recently just filled. And a lot of these units were filled during the colder months of the year. In Chicago, since we are very seasonal, we still believe there's a lot of natural upside in even some of the existing rents, even though there's the first tenants of a gut rehab building, because a lot of them were filled during the colder months of the year. So naturally, we think there's some upside.
Mhm.
We mentioned, it's a gut rehab, which includes all of these highlights, right? So everything's new. I will spare everyone from going top to bottom, but pretty much everything in the exterior was gutted out. Some pictures to show the finishes. This is pretty tasteful for the tenant class that's being attracted here in Chicago, as is probably most of the city. Quartz, stainless steel appliances, some exposed brick, real wood floors. This is one of the units that has a tenant had moved in, so you can see kind of the layout. I believe 3 of the units have islands, like true islands. The other ones have kind of extended islands. This is one of the duplexes, has a little bit more, most all the layouts are freshly opened up. So the floor plans have been completely changed from original. Snapshot of the rooftop deck and city views. There's also a deck in the rear, and there is select parking. There's only 3 spots that are rented out separately. So some of the tenants don't get parking, but since it's so close to the city center, it's really never an issue for tenants because they can go take public transportation. We have some floor plan layouts here. Like I said, floor plans were changed drastically from when the building was gut rehab, so everything's very open. These are the duplexes sample, and then we also did a sample of one of the simplexes. You mentioned the location's really good. This is a snapshot of where it is. West Town Noble Square is very close to the West Loop in downtown, probably only about a 10-minute walk to this business district, or maybe a 15-minute public transportation ride to the city center. A lot of restaurants in these areas, shops, and the neighborhood attracts a lot of the tenant class that's currently in there, young professionals, students, and potentially some families too. More about the location. This is just zooming in a little bit more so people can see how close it is to a couple of the, the Google building here we highlighted. Typically, if this building was south of the train tracks here, the price would probably be about 15% more, just because of the location. This is just such a dense business district, the Fulton Market District. 9094 is a main expressway, and it's only 4 blocks away from a retail strip here on Chicago Avenue as well. So again, the location is just super walkable, very friendly for anyone that doesn't have a car. Jumping into the finances, financial summary, the 6.6 cap comes from these figures. Gross, we have a 21% operating ratio, which is very lean and good, right? In general, the building kind of takes care of itself. There's no elevators, there's no amenities that cost a lot besides management, insurance, water, sewer, garbage. In Chicago, the owner is paying for water and sewer, snow removal, maintenance. And you'll see here that we broke out the RUBS fee that is being collected from the tenants for kind of billing back these utilities that can't be sub-metered. In Chicago, we don't sub-meter water or sewer or garbage. So this is kind of a recapture of those fees. We did a 5% vacancy expense, which in this neighborhood, honestly, is probably high. You could probably do a little bit better than this. So all these things considered, with the pro forma income that's currently in place, we have a net operating income of $140,000 approximately. With a projected IRR of 15.5. This is a leverage IRR. So again, if a cash purchase was made, it would look a little different. But most of these are very close to actual, if not actual. Some of them are broker estimate, like the electric, but that's a very small portion of the expenses.
Mhm.
Here's the current rent roll. I mentioned this duplex is leased. So the 15,000 a month gross is very close to being accurate. The tenants pay their own gas and electric. And like I said, there's this RUBS bill back for water and garbage as well, which covers kind of water, trash, and a little bit of your common electric, but that's a very low expense. But you'll see the unit bed and bath breakdown here. All the simplexes are about 900 square feet approximately, maybe slightly less. But they still attract roommates or a young professional working from home that uses one of the rooms as an office potentially. And you'll see lease dates are through 2024, and some of these tenants are already starting to express interest in extending their leases. We do have some comparables nearby that can be dove into. Again, not all of these are gut rehab, so we feel like they're very fair. The cap rate for something like this that is pretty much brand new is super competitive. We did break down the taxes here so you can see current tax bill is about $18,800. Um, and yeah, that does it for the OM and the building specifically, but let me know if you have any questions on some of the numbers or the, the cash flow or the NOI and how we got to those numbers, and be happy to dive into them.
Yep, I have a question. The current so let me ask you the location. So the location is a little bit north of the Chicago downtown. And what's the current kind of like demographics that of that locations that is attracting?
Um, Definitely young professionals, some students, people that work in the city, maybe some people that work from home, but just want to be in a close, retail, like want to be able to walk to shops and nice restaurants. Credit is never really an issue with these type of tenants. If it's a younger tenant, they are co-signed by parents, potentially, right? If it's a student and they don't have credit. Otherwise, gross income expectations here are typically about 3x monthly. So, most of these tenants are screened based on making 3 times monthly income,
Mm.
or 3 times rent as their monthly income, and likely all over 680 or 700 credit score, probably even closer to 750 or 800, to be honest.
Gotcha.
Yeah, and I can chime in a little bit. I own a 4 unit only a couple blocks away from this building, and the last tenant that I got is not even an outlier. He rented a 2 bed from me for 3250. I have a slightly wider building, but his income was about 340,000. He was 34 years old. It was still within the range of being a young professional. My other tenants are all late 20s, early 30s. All make 6 figures. All have credit scores, well above 700. So yeah, there are other areas of Chicago. Lakeview is one of them, um, where you will find more early 20s. This is demographically more likely to be young professionals in their late 20s, early to mid 30s. And people like it because it is very, very close. You could ride your bike into the city in 10 minutes, but if you walk around the area, it has a neighborhood feel.
Gotcha. Okay, cool. Harshal has a question, so come up.
Yeah, so go ahead.
So I was curious about the crime rate. I was doing some research on my end. It looks like Chicago overall just has a bad crime rate in general. So I wasn't able to decipher if this area in particular, how does that fare well with crimes?
Yeah, so I can tackle that one. So both my grandpas were Chicago police officers. My stepdad is a police officer. My sister's a dispatcher. So I kind of have an inside scoop on how crime's going and things like that. Chicago is a very, very segmented, city. So if you look, kind of on this map that Jake's currently got, as soon as you start to get a little bit west of the United Center, that's an area called East Garfield Park. And you see the Douglas Park just south of the highway there, 290, in the area that you start to see called North Lawndale. That area and west, there is a subsection that is called West Garfield Park, north of 290, and then Lawndale, south of 290. That area, in terms of the everything that we see on the map, I would say that small area accounts for probably 95% of the violent crime. And then the remaining 5% is just kind of spread out a little bit west of Humboldt Park, which you kind of see in the upper, mid to upper left quadrant of this map. Once you get west of that park, there is a little bit, over there. But basically, anywhere east of both Douglas Park and Humboldt Park, all the way to the lake, is typically considered safe. Now, crime can happen anywhere. There is crime everywhere. But the high crime rates that you see are very, very concentrated. And then there's areas on the south side that we don't even see within this map range that are somewhere in the range of 6, 7 miles south of the city, but are still the downtown, but are still considered Chicago. Um, when you get south, there is more crime, and then when you go north, it's great. So yeah, it's Chicago is not like widespread crime. I know that people outside of Chicago will see on the news, hey, another shooting in Chicago. We get it, like, but everyone here kind of knows, you know, where the crime happens versus where it doesn't happen.
Okay.
The other question I have was, what is the operating cost of this? So suppose you have about 2 units vacant. What is the cost that the owner is looking at?
Well, they're
In
currently
terms of,
fully occupied now.
Yeah.
We had
Yeah.
these are your expenses. Taxes, insurance, water, small electric bill, these are annual numbers. Property management, and then a repair, a repair expense. Vacancy expense is already taken out of the effective gross income. So you can see most of it is taxes, but as far as like operating expenses, it's mostly utilities in your management and any repairs you're doing.
Yeah, and what's important to look at is that, if you've done commercial deals before, Harshal, like, I'm just going to go ahead and assume you have. There's a difference between what we've got in terms of actual costs here and what a lender is going to force you to put in. So Jake mentioned, 5% vacancy expense. The reason that we put that in is because when you're working with a traditional, commercial bank lender, or, a small balance, like Fannie Freddie type loan, 5% for multifamily is a vacancy factor that they're going to force. But I own, 26 units all throughout the Chicagoland area, or will be 26 units, buying a 4-unit and closing in a couple weeks, knock on wood. But my trailing, 4 years of vacancy is less than 2%. It's probably closer to 0.92% last time I checked. But the 5% we put in just because that is what a commercial lender will force you to put in when they're stress testing something like this. Things like, janitorial and snow removal. I have, again, at the moment, 22 units, and I've had $75 of snow removal across all 22 units this year because we've hardly had any snow. So these are things that, on paper, a lender will force you to put in, but your actual expenses can be much lower, especially if you self-manage. So a lot of this is because a lender will make you put it in, but it's actually a little bit higher than the actual expenses. I own a new construction 3-unit in another area, and other than my tenant hitting the garage door, I've had no repairs and maintenance for almost 2 years now, just because it was a new construction, and this is basically the same thing. So we're playing a little bit safe, just because of what a lender will make you put in, but the actual expenses should actually technically be lower.
Hey, I have a
Thank you.
question about the real estate tax. The system tax is based on the past tax bill, or is it actually reflected the current listing price?
It's all based on the assessed value. I think they did see an increase after some of the work was done.
Okay.
Typically in Chicago, if you're around, the 1% mark of the true market value, you're probably not going to see your taxes shoot up too much. But it's a fair question. In Chicago, the assessed values do not follow purchase price. So
Okay.
your assessed value will not automatically be reflected to the most recent purchase, if that makes sense. It's
Okay.
based on a more collective aggregate of comps in the neighborhood. So if they
Okay.
think the neighborhood has appreciated 6% in the last 5 years or 2 years, your taxes will go up about
Okay.
6%.
Gotcha.
So in Chicago, we usually underwrite about a 3 to 6% increase every year.
Gotcha. 6 to 8% each year. That's good information. Yep. Okay. So, any other questions regarding this deal that we underwrite it so far? Any other questions? I think one of the my friend Carlene just joined. So I just wanted to give you guys a heads up about this, why we're doing this webinar. So it's an agent networking event. So the idea of this event or webinar, what we're doing this is because we wanna to share more information about real estate markets in different, especially booming states, metropolitan areas such as Chicago, Florida. And we do want to keep everybody, educated on different markets and what investment is, betting on, what a big hedge fund is betting on, what the markets, those things that we kind of take into consideration. And then we working with a local experienced partners like Jack and Michael, and they have experience in the particular multifamily investment property like this, and we find the great deals and then offering that to the Cohome investors. And this is benefiting, let's say, both investors. That way they have been informed with a different strategy, different deal, different opportunities across the nation, right? Multiple states. That way they can diversify, especially with the Cohome product that we're offering is every single product, the investor be able to invest a share up to 4 shares in the property, right? And instead of buy, use up all their capital to buy one property at one basket, right? We be able to allow investors to invest in shares in a property. That way they be able to diversify their investment capital into multiple states, into multiple properties they like. So that's kind of the idea about the Cohome, the offering that we have. Now, the reason why we work with agent very closely, not only because that we be able to work with a excellent experienced agent like Jack and Michael's team to source this great deals, right? The deals that are such as the cap rate above 6%. Those are especially in Class A properties and great location like this, it's definitely very rare opportunity. So not only will you source great deals from local, local expert like them, but also we be able to offering this to more realtors, whether it's in California, even though we're based in California, San Francisco, but we have about 35 brokerages so far, multiple states, and they be able to get more offerings from us, and they be able to add those, offering this product to their own clients and let them know, okay, wow, there's actually, you will be, as a realtor, you will stand out compared to other realtor because you have more information about out of state investment opportunities, and also just for also a more affordable ways allow your client to get into those kind of deals without breaking their bank, right? So that's kind of the value of Cohome. And why we're doing this is we wanted to, collaboratively talking about the deal, transparent about the deals, but also inform, acknowledges to agents. That way they know, okay, what's going on in other parts of the world. So that's why we're doing this. And this is a great deal that we found probably a month ago, and we really like this property specifically. We did underwriting based on the information that the Michael's team provided. They're very professional, get over the information to me, to our underwriting team pretty fast. And we like to offering this under a Cohome platform and offering to more investors. So for investors, right? I know there we have some investor today join this call. I would say we know firsthand, right? Traditional real estate investing requires a lot of experience, local knowledge, and specialized industry connections, time to manage, right? Those things. But in addition to that, you need a large upfront capital, especially like a multifamily home, this property. Those properties has more units, and they will, they need, especially commercial bankers, commercial lenders that require a larger capital upfront in order to acquire those kind of property. So essentially, a lot of investors are being priced out, and it's just big challenge for investor to face, and allow, kind of keep them from creating a sustainable portfolio. So that's why we're introducing, co-home. This is a co-ownership way, allows real estate investing to that has been specifically for individual investors. So this is a great platform for investor to be able to invest into the deals. Very similar to syndication. You probably guys heard of that before, but our deal is 100% of equity goes to the investors, right? Investor can invest 1/8 ownership in each deal all the way to a half. And that gives them a tremendous amount of leverage with other investors together. And every single deals that we even providing the financing option for investor. And the financing stack that we offering to our investor is no required W-2, no FICO score needed, and no personal guarantee. So that, financing has been a big hurdle for real estate investors, especially with a high interest rate environment. And now with this, financing that we package it together for our deals like this, investor will have a tremendous amount of ease in terms of how to get qualified, how to get in those deals, right? And I would say, just to highlight the advantage of by working with Cohome, is that first, you leverage, our agent expert network across the states. And with those knowledges, skills, resources of our local industry expert, you can invest confidently while we do the work for you, right? Second is that you'll be able to access valuable deals like this with a very low minimum investment. Any properties that lowest minimum investment is 1/8 ownership, all the way to a half. And we pull funds from multiple investors to offer a piece of a rare, high valuable real estate project for low minimum investment. So the third highlights about working with Cohome, or advantages here, is that investor can get in and out of deals quickly. So for this particular deal, that we structure that the 3 years exit term. So after 3 years, the property will be sold. If all the investors wanted to get out of the deal, so we have a kind of presumption that 3 years down the road, this property will be sold, and then we'll be able to offer investor at least a 10% cash on cash, right, for first 3 years. After year 3, let's say any investor wanted to keep their shares, keep the property because they wanted this cash flow, then we have options allow them to keep it while selling other investors fractional shares on the open market. So we have an exit strategy clearly embedded in place from day one that allows investor to get in and out of deals quickly. For some of our other deals, such as the fix and flip, we be able to allow investor to get out their deals after 3 months or 6 months, depends on the project scope, and then depends on the property estimation of ARV. Last, but the most important but not least, is that the Cohome models allows investor to diversify your portfolio in partnership with our well-established developers, operators like Jack and Michael. We be able to sourcing more deals across the states, and that will allows you guys to offer your investor a regular deals with the greatest potential. So that's the kind of the highlights about the Cohome, and can't wait to hear what you guys think and feedbacks. If you guys have any question about this specific properties, feel free to bring it up as well. Again, we're gonna continue doing this weekly webinars. Mostly is to share the deal, but also would like to have this opportunity for agent to networking. And I know today it's probably the timing isn't that great. So, but as we start developing, preparing this kind of webinar ongoing basis, we will start be able to offering some break rooms that allows agent to say, you know, I'm from California. I do have clients that are interested in Chicago market that they have been looking for. This is a great opportunity. I wanted to chat with Jack. Then we'll be able to divide it into different break rooms and allow you guys to connect, and possibly in different markets, stuff like that. But we will continue supporting agent network, and that's what we're here for. Okay. Any questions for me?
Mao, I have a question.
Yeah.
I have a question not about this exactly property, but more general question. So any property is owned by LLC itself and not by individual. So
Correct.
what advantages are for buyers holding title by LLC?
Very good question. So having the LLC hold the title will give tremendous amount of risk protection for the buyers and investors, especially most of the properties that we handpicked it and offering to investors are rental. And the renters, they, you know, there could be an incident that renter fall in the property, and then the liability is tremendous amount, right? And the LLC it acts as a protection where the liability is capped or limited at the LLC itself. It will not go after the asset that individual investor or member of LLCs has. So imagine I own this property and I'm a member of LLC. The tenants cannot sue. They can sue the LLC, but they cannot sue my other personal assets, outside the LLC. So that's why most of those fund or investment properties, the general sum of rule is to always establish LLC in the state where the properties are located to will protect their investors' liabilities. Does that kind of answer your question?
Yes, that's a great answer. But what about the financing? What company or bank provide financing?
Yeah, good question. So we actually work with the fund ourselves. We create this creative financing offering to investors for this particular vehicle. Every single deal that the LLC we created, a brand new LLC, has no any history from lending perspective. This LLC will become the borrower on the loan. And it's very similar to commercial property acquisition. And essentially the LLC will become the borrower and the deed holder of the property. And then the investor become a member of each LLC. And then within the LLC, right, the members can change, they can sell their shares within LLC in the open market, leveraging our agent network. And within the LLC, members moving in and out will not trigger the LLC financing term changes, right? It will not also, you will not either trigger the title changes as well. So that's why it makes make those investment more liquidable and easier to transact. So that's kind of the loan part is that LLC will become the borrower for the properties, and there's no any personal guarantee, which means investors are investors or members or owners of the LLC, and the LLC will apply in the loan from the lenders, and of course LLC generate rental income, and that's the rental income pay the loan mortgage payment by itself. So that will help, that will keep from, owners to continue contributing the capital to the property instead. Yeah.
Thank you.
Yep.
I have one more question.
Yeah, of course.
What about interest rates?
Interest rates, good question. Interest rate that today, we offering for this kind of loan is 7, like mid 7, low 7 to mid 7, depends on the properties that lender is looking at, our underwriting team is looking at essentially. So, which I think is pretty good a rate, to be honest. If any individual buyers, probably Jack, Michael, they can give you guys some feedback, but typically for like a traditional financing, which you have, the buyer has to come up with a W-2 income, their FICO score has to be above 700, and their debt to income ratio has to lower than, such as like, 1/3 of their debt. Anyway, it's just, if you adding all those documents today for the traditional financing, the interest rate right now is about 6.5 to 6.8. Could be sometimes or even go up to 7, depends on the property, depends on the market. And we be able to offer 7-ish, 7 to 7.5, that range, for offering to investor with none of those documents needed. And the most important thing is those property will have no personal guarantee for investors. So which means that the lender will not go after investors individually. They will only go after the LLC, the property itself.
Yeah, so interest rates are pretty much competitive. I mean,
Pretty
they're not
competitive. Right. Yeah, what we're providing for this particular loan is pretty competitive, especially the first 3 years we offer 0 mortgage payment. So the first 3 years that we offer 0 mortgage payment. So that will help investor to have a great cash flow. So that's why most of the deal that we structure is only 3 years. After 3 years, the rate mortgage payment will start kicking in, and that will make the cash flow less desirable. But the first 3 years always going to be around 10% or even higher. So
Thank you.
yep, absolutely. Any other questions for
What
me?
depreciation and cost segregation do you, if the LLC wants to depreciate, like what depreciation schedule do you do, or will you offer the ability to do a cost segregation and pull any of that forward?
Yeah, absolutely. We have our CPA team that they handles that. So we offer the investors K1, and we have put the cost segregation and the depreciation schedule. I think most of the properties that we use is 27.5 years depreciation schedule. And again, those are property tax, insurance, those interest, even be able to allows investor to apply for their individual tax return that will to deduct a lot of tax for them. Yeah, void tax.
Got it.
Yeah, it's a great question. And we do distribute the rental income on quarterly basis. So, so every year, let's say every deal this particular deal we offer 10% cash on cash. So each quarter will be 2.5% cash return for investors. Okay, any other questions? We're gonna continue working on this. We're gonna continue providing a weekly webinar like this and share more info and feature more deals like this.
Great. Okay. Thanks for the opportunity.
Of course. Okay. All right. I will see you guys next week. Appreciate it.
All right, take care. Bye, everybody.
Thank you.
Bye.